The first few months of 2026 have not been about broad market rallies. Instead, the story has been far more selective. While volatility has continued to shape overall market sentiment, only a handful of mutual funds, particularly thematic and sectoral ones, have managed to deliver noticeable year-to-date performance. This diversion itself tells an important story. It suggests that returns in 2026 have been concentrated in specific pockets of the market rather than being widely distributed across sectors. Against this backdrop, looking at the top performing mutual funds of the year so far provides insights not just into performance but also into themes currently driving market momentum. Hello investors and welcome back to the Equitymaster channel. I am Mitali Thoke, research analyst here to simplify mutual fund investing and guide you on a smarter wealth creation journey. So here we have considered all active and passive mutual funds to gauge the performance of funds that have delivered the highest return in the past 1 year on year-to-date basis. One striking observation across these funds is a common underlying theme. Most of them are beneficiaries of India's ongoing policy-driven capital expenditure cycle. First is the HDFC Defence Fund. The top performer of the year so far is also one of the newest entrants in the thematic funds universe. HDFC Defence Fund has gained 11.3% since the start of the year. It was launched in June 2023, making it barely 3 years old. Yet it has established itself as a front runner in the category that has seen surging investor interest. The scheme aims to provide long-term capital appreciation by investing predominantly in equity and equity-related securities of defence and allied sectors. The fund maintains at least 80% of its net assets in this mandate, giving it a highly concentrated and directed exposure to India's defence industrial complex. Here's a table showing the overview of HDFC Defence Fund. The fund is almost entirely deployed in equities with about 96% allocated to equity and equity related instruments and the remaining 4% held in cash and cash equivalents. Within the equity allocation, the portfolio reflects a blend of market capitalization, with large caps making almost half of the portfolio. The fund currently holds 22 stocks. This deliberate concentration means the fund is designed for investors with a high conviction view on India's defense build-out. Here are the top holdings of the fund. Bharat Electronics is the top holding, which continues to win large government contracts. Meanwhile, Bharat Forge, with 15.27% weight, reflects the fund's exposure to artillery and advanced foreign segments. The fund's standard deviation of 23.58 is on higher end of the funds in its category. As the fund was launched only in June 2023, longer-term risk-adjusted metrics such as Sharpe and Sortino ratios over 3 to 5 years period are not yet available. Overall, the fund is best suited for investors who have a well-diversified core portfolio and are allocating a tactical slice to the India's defense theme, ideally with a minimum 5 to 7 year horizon. Next on the list is DSP Natural Resources Fund. The fund was launched on 25th April 2008 and is among the oldest thematic funds in the natural resources and energy space. Its 2026 return of 9.18% so far reflects elevated crude prices, geopolitical disruption in energy markets, and a re-rating of metals and mining stocks globally. The fund seeks to generate capital appreciation by investing in equity and equity-related securities of companies in India and overseas that are engaged in natural resources. A defining characteristic of this fund is its ability to invest up to 35% of its corpus in units of BlackRock Global Funds, the Sustainable Energy Fund, and the World Energy Fund. This feature gives it a global flavor that most domestic thematic funds lack. As of April 2026, 81.5% of its portfolio is in equities, while 18.5% is in a mix of debt and global fund units. Its top holdings are dominated by the energy sector, with ONGC as the largest holding, followed by Tata Steel and Jindal Steel. Overall, the fund appeals to experienced investors who wish to allocate some part of their portfolio to a higher risk commodity linked theme. Third on the list is again DSP Fund, launched on 11 June 2004. DSP India Tiger Fund is one of the oldest thematic funds in India and has witnessed multiple infrastructure cycles, economic reforms and policy pivots over the 2 decades existence. The fund's primary objective is to generate capital appreciation from a portfolio constituted of equity securities of corporates that could benefit from structural changes brought about by liberalization in economic policies or investments in infrastructure by both the public and private sectors. The fund's top holdings include NTPC 5.26%, L&T 4.14%, Apollo Hospital Enterprises 4.49%, Power Grid Corporation and Multi Commodity Exchange of India 3.05%. Industrial products accounts for 18.25% of the portfolio, followed by construction at 15.04%. Electrical equipments at 10.28% and aerospace and defense at 6.67%. At an expense ratio of 0.74%, the fund offers some cost efficiency. Next on the list is Canara Robeco Infrastructure Fund. With 2026 returns of almost 7%, the scheme aims to generate returns by investing in equity and equity-related instruments of companies operating in the infrastructure sector. It targets long-term capital growth and has bias towards large market capitalization stocks supplemented by selective mid and small cap positions. The portfolio is spread across approximately 49 stocks, with the top 10 holdings contributing approximately 36 to 38% of the net assets. The fund has delivered 5-year CAGR of 27.57%. Its standard deviation of 15.47 is moderate, reflecting its diversification. Last on the list is SBI PSU Fund. This is a fund that has been one of the most talked about stories of the last 3 years. SBI PSU Fund was launched on 7 July 2010, and for most of its existence, it was considered a low priority thematic fund in a market that was influenced by private sector consumption and technology plays. That changed dramatically in 2022-23 when the cycle for PSU stocks turned up. The fund aims to provide long-term growth via active management of investments in a diversified basket of equity stocks of domestic public sector undertakings and their subsidiaries, as well as in debt and money market instruments issued by PSUs. At least 80% of its net assets are mandatorily invested in PSU stocks. The fund is heavily deployed in equities with 97.84% and the balance in cash and cash equivalents and a small T-bill allocation. PSUs have historically traded at a discount to private sector peers. The fund's portfolio turnover is 26%. Here are its top holdings. The PSU re-rating of 2022-25 was structural event for SBI PSU Fund. The fund similar to it with heavy PSU exposure naturally saw their risk-adjusted metrics improve dramatically during this period. Whether the Sharpe and Sortino ratios remain at this elevated levels as the cycle matures is key question for prospective investors to consider. With a return of 6.06% in 2026, SBI PSU Fund continues to compound even if the pace has moderated compared to heavy returns of 2022-24. To conclude, apart from the funds above, here are the others that have performed well in 2026 so far. The funds mentioned throughout this video share a common thread. They are all beneficiaries of India's ongoing policy-driven capex cycle. Whether it's defense modernization, infrastructure, PSU reforms or natural resource demand, each of these funds is riding a structural wave rather than a fleeting trend. However, the divergence in risk profiles is instructive. Also relying on past return is not the ideal way to select funds to invest in. Investors should carefully analyze the scheme's risk ratio, fund manager expertise and other key performance indicators before making investment decisions. So if you found this video helpful, hit the like button and subscribe to our channel to watch more such interesting investment related videos. Signing off for now, invest wisely, happy investing. The securities quoted are for illustration only and are not recommendatory. Past performance is not an indicator of future returns. This video is for information purpose and does not constitute any kind of investment advice or a recommendation to buy, hold, sell a fund. Returns mentioned herein are in no way a guarantee or a promise of future returns. As an investor, you need to pick the right fund to meet your financial goals. If you are not sure about your risk appetite, do consult your investment consultant or advisor.